Well, good morning. Good morning. For those of you who have been waiting for our live session, I apologize for being a little bit late. Had a little bit of technical difficulties. Couldn't get my software to log in. I don't know what was wrong. I had to clear the cache. I had to do all that kind of weird stuff. And I want to kind of show you where we're at today. What a comedy of errors. You'd think I was brand new at this. Well, I guess to some degree we're all brand new. Every single day it's a brand new game, right? All right, look at what we're doing right here, right now. I want to show you this before we get too far into the bell. The bell opened, so we can come over and take a look at the opening bell, see these markets that have taken off and run. Let's open some of these things up. We don't need this one. Let's delete that, and we don't need this one. Delete that. And there we go. A little bit bigger screen. All right, there's the Russell. Look at the beautiful trend on the Russell. Holy cow. Everything's moving like crazy right now because today is a big news day. Let's bring this down here. Everything is a big news day. This is a Fed day, right? If I can run a little bit behind schedule here. Where's my Fed day? Troubles in paradise when my software doesn't work in the morning. All right, to impact. There we go. All right, so 6:30 this morning, we had core inflation rate. Let's look at this. The forecast was 0.3. The actual was 0.2. That was month over month, year over year. The forecast was 3.6. Came in at 3.4. Look at the chart on that. Core inflation. Inflation has been coming down over the last month. That's good. Things are not as expensive as they used to be. All right, month over month, not so good. But year over year, coming down. All right, so that's good. Inflation rate, month over month. So here again, a little bit down. So that's good. 0.1 to 0. So we had no inflation. Inflation rate year over year, 3.4 to 3.13. That's good. Came down. How about that? CPI, consumer price index, right? Consumer price index. Well, things are getting more expensive. How can that be? Inflation rate, consumer price index, 314.5 to 314.7. So it went up. CPISA. Now, I don't know the difference between that one. Seasonally adjusted. Oh, yeah, that's right. Seasonally adjusted, 313.5 to 313.225. Not much of a change. Crude oil coming in at 8:30 and at 7:30 my time. This is UTC6. Make the adjustments for yours. This is the Fed interest rate. Decision is coming in at 12 o'clock. They're not expected to change it. FOMC economic projections. 12 o'clock monthly budget statement, 12:30 Fed press conference. It's going to be a big day today. I thought yesterday would be quiet, and it was not. It just leads you to believe that sometimes people know something. All right. Sometimes these are supposed to be secret reports. You thought they were secret reports. Sometimes they are. Sometimes the market doesn't move and then takes off and goes like crazy beforehand. But you know what? These are not secret reports. There's people who knows what's going on. Look at this. Look at this. Look at this. The market rallied really hard yesterday. And then, of course, on the report, it took off. So some people don't know. They're not supposed to know. But there are people who know. And they get away with it. All right. Let's come and talk about what's going on right now. Why are we up $890? $880? Well, I'm going to show you both our what we did yesterday. And then we're going to talk about how I lost money. But actually, and that was the little marquee out front, right? I'm going to show how we lost money. This was our setup. Is this our setup? This one's left over from yesterday. This is the one we did before. This is not what I wanted to show you. I don't have this one here. I don't have it, but it's almost exactly the same as my real money one. And I do have my real money one. So I'm going to show you the real money one. Is that all right? I don't show you the demo one. I show you the real money one. Because in the demo one, look, we're up $890. 895, 870, 800. Let's take that profit. All right, we're going to take that. So we're going to go ahead and we're going to liquidate that. First thing in the morning, look at the market took off like a crazy wild banshee. What's a banshee? Why do we always say it? Took off like a wild banshee. So this is where we were yesterday. This was our insurance policies. You can see them down here on the screen. This is where the market was yesterday, or when we put these on yesterday morning. And then the market took off and ran all the way up here. Now this is all squished down, so it doesn't look very big, but it ran all the way up there. That's $1,500 per contract, and that's what we traded was one contract, right? So $1,550. And this is the demo account. And this is all I got left over on the demo account. So I can't remember. I didn't take pictures of the demo account because I was focused on my real money account, and I apologize. I thought I had pictures for it, and I look at it and I was taking pictures of my real money one. So I'm going to show you my real money account and not my demo account, but this is still in the demo. All right. So we have two classes running. We have the real money account and we have the demo account. Now I put the real money one on after class is over. I put the demo one on during class, and then as soon as class was over, I went and put the real money one on. So this was a $1,500 move, and then this morning when those reports came out, it was a $2,000 move. Holy smokeroonies! That market really took off. Oh, you can't see the numbers down here. Get out of the way, Lan. Let's do this with this one here. Oh, now you can't see the chart. Okay, let's do this one here. All right. So that's. And now you can't see let's do this one here. All right. So there we go. So that market's starting to rally. It's actually making some more money. We're up $900, $700. I'm going to show you the plebeian mistake I made on my real money one because it's closed out already. I closed it out, took the profits off of here. I wanted to do this one. This is in the demo account. I want to do this one for you guys. So we're just going to liquidate it. Look at that. It's almost $1,000. We can come in here. We're going to come in, liquidate the multi-leg. We can let it run. We can just let it run and see if it wants to make more money. Right, but I want to take it off, and we're going to do something new. All right, so we're going to come in here, and let's just for fun. It's almost $1,000. Let's see if we can get it to give us $1,000. Come on, baby, give us $1,000. It's coming back now. There it is. Come on, go up. Needs to pop up just a little bit. Just a little bit. Give us $1,000. There we go. So we closed out, should be 1,045 with our slippage. All right, so it slipped in our favor. This demo account. Real money doesn't slip in your favor. All right, but let me show you what happened. Okay, so now that's $1,000. So we actually ended up making money on this one because when we closed out yesterday, we were down 700 and I can't remember. I think $700, about $700. And so because we held this overnight, well, we got our $700 back plus $300 in profit. So we're going to go and I'm going to write this into our spreadsheet. All right. There's our spreadsheet. And we're going to come in here, and today is the 12th. So the 12th. So yesterday we actually lost $300, right? Or $700. Sorry, minus 700. We're just going to guesstimate right here. We lost $700, but today we made $1,000. 1,045. Right? So that's how that turned out. Now that's today's Wednesday. Is today Wednesday? Yeah, the 12th. Okay. So that's how that turned out. So we ended up with $580 because we made $120 day trading. So we lost $700 yesterday, made $1,000 today. That was pure sheer luck. This market ran that hard today, and we got to pick up that extra money. Yesterday's trade, if we would have closed that out yesterday, we'd have been down $700. All right. So let's come back over here, and I'm going to show you the real money and my stupid comedy of errors why do I make mistakes on real money and not on the demo? I don't know. I'm just that kind of trader. All right, here we go. I didn't make that many mistakes. I mean, I just made one stupid mistake. But here's the real money account. And here's how it came out. All right. So we made three. Now remember, when you sell your options, you get that premium no matter what at the end of the day. So if you sell it for $500, you're going to get $500. And and I say this all the time, you're going to get the full premium. You sold it, it's yours. You can walk away with it, it's yours. You're going to get it. All right. So we sold two options, right? We sold a put and we sold a call, and they give us the full premium. There they are right there. You can see them in my account. This is a real money account. 39734 34734. So that's what we sold those for. And that was our full premium. We actually, it's funny because we sold them for a little bit more than that. So I think that's the slippage or the spread that they came in at. Anyway, we got their full premium. There's where they give us the money. No matter what the market does, you got to get that premium. Now, an interesting thing happened to me yesterday. I got exercised against, and they gave me the position on one of those shares. And so the position was down $1,500. So the two against it made me a losing trade of 759, which is exactly what we had in the demo account too, almost to the numbers. So they gave me a position, exercised me. It was because it's a European style option. They can only exercise at the end of the day. And I don't usually do this. Pretty rare that I let my options run all the way to expiration. But I wanted to see if I could get the full premium, and I thought that the market was going to come back down. So the market was in our cone of probability. I can't draw on. I'm going to try again. Oh, okay, watch this. I hate the way this thing draws. Okay, I'm going to draw on this PDF, PNG, whatever it is. Okay, so I'm going to draw on it. And our cone of probability was like this, right? Not very straight. But that's our cone of probability. And the market came down, and it was cone of probability was, if I could draw it straight, it was a little bit more like that, okay? Because what I was doing is it came down, and it touched the cone of probability, came down right there. See that? It came right back down. And if you remember, oh, that's why I had that on the desktop yesterday. I wanted to show you. Because this is what happened to us. Oh, it wasn't that one. Hold on. This one. Remember this one? Oh, that's a video. I don't want the video. That one. Remember when I did this? And I thought the market was going to go up. Okay. And again, the same thing. I thought the market was going to go up and then stay there and just go sideways into expiration. And it didn't. It flushed all the way back down. And then I said, Lan, you stupid, dumb idiot. It does that all the time. So I put this one on, and because I put the other wing out there, the other condor, I lost money because it did come back down here. And this one made money, but this one lost as much money as this one made. And so I was like, well, I'm not going to do that again because I think the market's going to fall. And so what happened is the market didn't fall. So see, this time, I don't understand. How does that erase? It didn't erase. I don't get it. I don't get it. You hit erase and then try to erase, and it doesn't erase. Whatever. Recent changes will be lost. Okay. So I thought it was going to come back down. So I thought it was going to come back down into the cone of probability. And it didn't. I thought it was going right here. It came right down and touched the cone of probability, right to break even. And then it turned and rallied really hard back up and out of there. And that just like made me so angry. $712. That's my $712 loss right there. 712. See? So 750 was our break-even point. And that thing came right back down to my break-even point, turned and rallied back up as opposed to falling back down to the VWAP. It was almost as if they knew Lan Turner had an option right there. I got my full premium on both options, the sold options, 397, 347, and then they exercised me because I let it go into expert. And I don't generally do that. I'll usually liquidate it before the market closes, or as you know, I like to liquidate an hour before the market closes. I like to liquidate before it goes into power hour. So this was power hour, and that's what it did in power hour. right? It took off and went to the moon during power hour. I thought it was going to fall and come back down here during power hour. It was outside my preview here. And of course, as soon as I put it on, look at how close it came in here. It went sideways for a little while, but then, man, it took off. Something happened right here, and it just went straight out of the cone of probability. And then I thought it was going to come back down because that's what it did before. And if I would have put another one on up there, I'd be a superhero right now. But instead, I didn't put it on like I did before because it fell back down, and then it didn't fall back down. So if I'd have just reversed those two strategies, I'd been great. So the market rallied and came all the way back up here, and we closed out the night with a $700 loss. That's the 712. You can see it right here, 759.64. Okay, so it's down 769.54, but I still had my two positions open. Don't forget, I still got my insurance policy on. So Lan comes in, and his dumb self doesn't know how to do math. Comes in and does this. So now I'm sitting here and I'm saying, okay, I've still got my 3-day straddle on, and it's up $96. So in my brain, I'm thinking, okay, I'm down 700 on the closed positions. I'm up $96 on the open positions. So I'm up $96 on the open positions. I'm really only down $600. So I'm only down $600. Only $600. That's a lot of money to me. And so I'm down $600. And so I start doing the math in my head, and I start thinking, okay, well, I need an additional $600. I'm down $700. I have $600. I only need $600 more. I need $600 more. So I do the math, and I do the math, saying I need $600 and $700. I really needed $800 because because that 96 doesn't get subtracted out. That's part of the money I need. I need that 96 plus an additional $700. So I needed $800 to break even. I just want to get back to break even, just get my money back. All right, you know me. I'm just like, well, this thing didn't work out. It left the cone of probability, and that's not how we make money in these things. So the insurance policy is meant to just get me back to break even. Let's just take it off at break even. Just get me my money back. So I set a limit order on it so that the money would come back to me if the market hit $659.34. I mean, I almost set it right at $650, and it gave me $659. And that's $100 shy of what I needed to break even because I didn't take into consideration that the 96 had to be part of that. Had to be in addition to the I was at 96. I needed an additional $700, and that 96 is subtracted from the 659. So I ended up closing out this position with real money. You saw me do the demo account, and I closed out 1,000. Well, in the real money account, because I came in before the market opened, right? Well, I set a limit order on it last night before I went to bed. I said, if you just get me back to break even, just take it off. And I miscalculated. I undercalculated by $96.84 how much money I needed. And so it gave me exactly what I asked for, which was $100 shy of what I needed. So in my real money account, on my real money spreadsheet, I had to enter a $100 loser. So there you go. Land can't do math. Do as I say, not as I do. Land can't do math. Oh, and look at the market still running higher. My goodness sakes, what a crazy market. Let's come over here and look at what's going on here. So that's how the cookie crumbled for me yesterday with my real money and with the demo. So demo, we made money. The real money account, I lost $100. All right. There you go. There you have it. Lane can't do math at 10 o'clock at night. Okay. Things are starting to settle down a little bit. The S&P is still running. The Russell's being a little bit crazy here. Came down, touched the 200 period moving average. Looks like it bounced off of it. Whether it did or not, nobody knows. All right, let's come and say hello to a few people. See who's in the room. We got Kim Moss coming in at number 1. Kim gets the gold medal today. Nice to see you, Kim. It's not a race. Bruce coming in at number 2. How you doing, guys? We got Mark Boucher coming in at number 3. Nice to have you in class, Mark. Gary Thomas, good to see you. We got Kirk Schwartz saying hello. And we got Michael Bruce bringing up the tail here. Good morning, everyone. We got a lot more people watching the class than what's put up your marquee. If you guys want to say hello, I'll make you famous. All right. So new people come. If you want to subscribe, you can come and play in our sandbox. Hit that little bell, and you'll be notified when we do live classes. We've been doing live classes every morning, but that's not going to continue. I can't do it every single morning. I used to only do the live classes 3 times a week or 4 times a week, 3 times a week, 4 times a week. And then I went 5 times a week, summertime. And I don't know. I just like doing it. I like to come and hang out with you guys. I'm going to come and do it anyway. I'm going to come and sit at the computer and watch the markets and trade and see what's going on and put on strategies and strategize. And I might as well do it with you guys if I'm here. And but I got to take a break once in a while and sleep in, not get up so early. Early, sun's up. I need to get up earlier is what I need to do. Go to bed earlier is what I need to do. I stay up all night and then I get up early in the morning. All right, we got to make something happen here. We got to make something happen. We only made $1,000 today. That's not good enough. Let's see. Let's try something new here. I don't want to put on an iron. I don't want to put on I think the market's going to rally today at noon. Let's put on a married put. All right. What is a married put? Well, let's talk about a married put. A married put is, and I did a married put in Doc Brown's class today. Doc Brown is on vacation. He teaches a class. He charges you money to go to it, though. But that's okay. If you guys want to pay to watch Doc Brown, he has a class on Roku. You guys know Roku TV? He has a class that he teaches on there every morning where he just talks about stocks. And so that's kind of a fun class. You can go subscribe to that. But he's got me teaching that today. And that's why if you see I'm the videos I do for his substitute teacher class, I'm his substitute teacher. He has having me teach that class. So I've been posting the videos I've been doing for his substitute teacher class. They're paying for it. Those guys are paying to see those videos. I'm posting them into my YouTube channel for free. Hope he doesn't get mad. Hey, those are classes that you're teaching for my class. Those guys are paying for it. And you're giving it away for free on YouTube. Yeah, well, I want my students to see it too. Look at this. We got a nice little break here. This is a 2-minute chart, though. Do we want to take that long? I want to show you something. I want to do a married put. So we're going to come in here and we're going to do the expiration, tomorrow's expiration. And we're going to come in here and we're going to buy a put. And I want it to be right at the strike price that the market's at, almost exact. So it needs to either fall or it needs to rise. And it looks like it's rising. So I want to get into the market at the exact same strike as the option. All right. So let's come in here and I'm going to time this. And I could probably time it better on a smaller range, on a smaller chart. Okay, that order is sitting right there. Yeah, I'm going to kill it. I'm going to put it in here again. Okay, I'm going to buy a put, and I want it to be either here or here. I want the exact price. So we can put that on there if I think the market's going to go up there. I'm not sure if the market's going to go up there, though. It's got 2 days till expiration. We're going to marry this thing, all right? Get your ring out. Put a ring on it if you want it. Put a ring on it. Isn't there a song about putting a ring on it? You didn't put a ring on it, so you didn't get it. All right, put a ring on it. Okay. Oh, we got one down here. Let's see, where's that other put? Buy a put, buy a put, buy a put down here. Oh, it's way down. It's clear down here. Which one are we going to do? Which one are we going to do? Now, these are not order. I didn't send them to the order yet, so I'm going to time it, time it, time it. This wouldn't be a little bit in the money, wouldn't it? Now look how much these things cost. $1,400, $1,200. But I want to put out a married put because I think the market's going to go up. Why are you buying a put if you think the market's going to go up? Because it might go down. We've got a large amount of volume or implied volatility that's going to happen this afternoon, right? When the Fed announces. So I'm going to put out a married put, and I think the market's going to rally. I think it's going to go up, but it could go down. So come on, I need it to go to one of those green lines, whichever one. I don't care. Go to a green line. This one here is fine. And I don't know, maybe we should do this just one day. Land, it's there. Are you changing your mind at the last second? I am. Let's kill this one. Delete that one. We're going to put it, okay, buy a put. It's there right now. Okay, let's just, we got to use a limit order. Place our order. It's not going to let us fill it like that. We got to go to, we're buying it, so we got to go to 26. Okay, so we're in the market. Now I'm going to come in here, and I'm going to go to the trading tab. Oh, crap, I missed it. Now we're long. Okay, we're long at the exact same price as the strike of the put. So now we're long and we're short. But we're not short until for 2 days. That's why I was like, well, maybe we should do this with 1 day, 0. Let's test it. That's what we are. That's why we're in a demo account. We're going to see which one's better. We're going to do a 0 days. And I'm going to buy a put. Buy a 0 day, buy put too, just to see what happens. Okay, and we're going to have to go up to 18, place that order. Okay, now we're going to trade, and we're going to buy. We'll go along with one. So we got it on here twice. We got 2 married puts. All right. One was 0 and one with a day, and we're going to see what they do. That's what we're going to do. That's what we do here, right? So we have a married put. So we have 2 contracts and we have 2 put options. So we're long and we're short. So what is that? That means that what's going to happen is at expiration, which is today, the market's going to have moved far enough in our favor to cover the cost of the put option. But the put option, we bought the put, so it's going to cover us to the downside, but only at expiration. At expiration, we're going to have full 1-to-1 ratio, right? But it's got to pay for the options. So now I got 2 options. We have to think of these as 2 separate straight trades. So how much did I pay for it? It says I paid $12,800 for that one. That's not right. What? Options chain. Friday. 2. At the money. $1,200 is my cost basis. Why in the heck does that thing say I paid $12,000 for current value? $12,000. That's not right. I didn't pay $12,000 for it. I did 9 days till expiration. How did I do that? Still, it's wrong. Even with 9 days till expiration, it's only $1,800. This is how we get screwed up. This is how we get screwed up. You can't charge me $12,000 for that put option with 9 days till expiration. Okay. Close position. I'm not going to pay $9,000 for it. It's not going to help us with our strategy. Okay. Positions. So we're going to do the 0. Let's go back to the 2 days. It's $1,200. That's the 2 days. Do we have 0 days till expiration? I can't remember what I don't know what I've got. 2 days till expiration is my put, buy a put. Oh, that was the contracts. That's why. Stupid me. I thought those were the options. So it was right and I was wrong. Okay, let's put them back on. 2 contracts. Okay. That's why they say $12,000. I was like, what? How can I pay $12,000 for those options? Those are not options. Those are contracts. And this contract expires in 9 days. So the S&P 500 June contract expires in 9 days. We need to start looking at rolling over into the July contract. My stupid self again. Blaming the software. It's my mistake. All right. So now we have we closed out another. That's the problem is we had $125 in profit in there that is not going to show up in here. We're going to have to remember that. Okay, so we've got our married put in there. We got 2 of them. We got one that is sitting here with 2 days till expiration. We got 1 0 days till expiration. This is 9 days till expiration, but that's the contract. That's not the options. That was my mistake. All right. So I got confused there for a second. So our contracts are covered by they have to make enough money. The contract has to make enough money to pay for the options. Right? So we don't start making money until we got 2 of them. So until Friday, market has to rise. You have to add those 2 together. What was our cost basis? $1,308.87. So 8, 9, 10, 11. So $1,187. $1,187, right? 8, 9, 10, 11. Yep. $1,187. That's break even. Right there. Draw your line in the sand. That's your break even point. It's got to be above that point. Now there's 2 break evens in here. That's the combined break even. That's the combined break even. Yeah, I don't like this. Okay, so that's your combined break even, but we have a separate break even in here. So let's do 1 break even. Let's do them separate because we're doing them as if they're two different options. Okay, so we're going to come in here. And we have 1 break even at 887.50. And that's, we've already got one. Okay, we're going to go from not from there. We're going to go from the strikes where we had it. So it was 887.50. 887.50. Okay, right there. So that's our first break even. It's got to be above that point to start making money. And that's on the first one, and that's today. So it's got to do that by the end of the day. And then the other one, drawing the wrong line. So the other one has to go from here and has to go up $1,300 because we paid $1,300 for it. $1,300. Wow, look at that. I put that right almost exactly where it needed to be. Okay. So that's 1,300. So that's the first one, right? So the market has to rise, and we already took some profits off, so that's not really fair. So we can reduce those. Hey, we can reduce these. Let's do it in the break even. So we closed out 75. We're going to take $75 off of each one because Lane screwed up. Okay, so we're going to come down here, take $75 off. So we're going to go right to $800. That's about close enough. Close enough for horseshoes. Okay, so that's our break even on that one because we already took some money. We'd take another $75 off of this one. So we're going to go down to 12.25. Oh, moving the wrong thing. 12.25 right there. So that's our break even. So the market has to be above there to pay for these things. Now, if the market goes down at expiration, we won't lose any money. We only lose money if the market doesn't go up far enough, right? Why? Well, because these are put options and they will assign you, as we found out, right, in our last example, right? If you let it go all the way into expiration, not that one, this one here. No, not that one. Can't grab the right picture. See that? How they assigned me a short position. So they will assign me 2 short positions at that exact price, which was supposed to be where my order was. So they would assign me 2 short positions, and I have 2 long positions from that exact price. So I will absolutely be, boom, canceled out, no loss. If the market tanks and comes anyway, well, it doesn't even have to tank. It just, if it goes down at all, I don't lose any money because I have a hedge on, a perfect hedge, because it'll be a 1-to-1 at expiration. It's not a perfect hedge between now and then because it'll be whatever the delta is, right? But at this point, at expiration, which is on one of them at the end of the day, one of them's at the end of the week, that means we're going to have to leave this thing on for the whole week. Oh, well, we know that's what's going to happen. So we can take it off tomorrow if we want to do something new. But this, if the market goes up, it'll go up and it has to pay for these insurance policies. So the idea here is that you can do this on a longer term basis. We oftentimes do this on stock, in the stock market. We don't do it over here very often. It's not a day trade strategy. It's a strategy that you use when you want to, like, I love Microsoft or I love Apple, and Apple is really high right now. It's sitting up there at what would that be? A C3, and I want to buy Apple. Well, that's not a very good place to buy Apple at a C3. Well, put on a married put then if you're going to buy an Apple at a C3. So if you buy Apple at a C3, which is a really super low probability, and if you don't know what the probabilities are, then you need to get my book because everything's in the book. All the probabilities and telling you what a C3 is, it's all in the book. All right, this is the manual to the class that gives you all the probabilities. Here we go. Here's my probabilities table. And here's where I teach you how to count and measure and put in all of these probabilities, just like at the blackjack table. You can go out and you can get my book. There you go. And that tells you the probabilities, all right? Where to be buyers, where to be sellers, what your probabilities are. And so you can go get my book out on Amazon and just search Lan H. Turner, and you get that manual to the book. It's 220 pages, costs almost nothing. It's not like it's a $200 course or something. It's just the book to the class. It's the manual. It tells you how we do all this stuff. So get that off of Amazon and then coming back and go get your software. Don't forget to get your software. You have to get your software too. And where is the software, Lan? What's the software you're using, Lan? I'm using Track and Trade. I have the Track and Trade Futures version. That's what we're using right now. This is the Track and Trade Stocks version. You can get that one too, and you can come play with us. Go get your software. It's over at trackandtrade.com. Download it, and then come and play with us. And you can do what we're doing here. And right now, what we're doing is just watching this market die, because this is probably what it's going to do until noon. It's made its big move. Now it's where it wants to be. It's just going to sit here and wait until noon. We're probably not going to get much. So that's why you put on this covered, this married put. If the market takes off and runs like crazy, all it has to do is go above those. And you're like, wow, that's a long ways away, $1,000. Well, maybe not so much. If you come to, this is a range bar 6 chart. If you come down here and go to just let's say a 5-minute chart, to see where those lines come out. Did I change it? Didn't change it. 5-minute. Oh, wait a second. Go to a 2-minute chart. See those lines? There they are. So that's where it has to go in the next 2 days. Well, one of them has to go up to this one today. That's got 2 days to get above that line. If it gets above that line, anything above that line is profit. All right. So anything above that line is profit. Come on, my mouse is dead. I need to get a new mouse. So anything above there is profit. And anything below here is no loss. You're not going to lose anything. You do have this buffer. So if it ends up inside this box, it's what you don't want it to do. Let's go out one more. Go out to the 15-minute chart. What you don't want it to do is end up inside this box right here. Let's get rid of all these. Delete all calculators. Do we want to delete all of them? No, we don't. Just delete that one. So we'll keep these two because that's 800, and that's our profit right there. Okay, what you don't want it to do is you don't want it to end up right here, because this is where you'll lose some money, because it's got to go far enough to pay for the premium of the put options. That's why oftentimes we'll do this on a longer term basis, right? Because we give this thing more time to get above our break even. Of course, if you buy it at a longer term basis, then your break even lines move higher. So it's all relative, and it all comes down to that again. It's that cone of probability. It's the delta cone of probability. Where is that thing? I moved it in our spreadsheet. I don't even know where I put it. Now that's frustrating. Well, this shows it off pretty good. It's that delta cone of probability. It's this thing here. See this? You have a cone of probability. The thing is we don't have a cone to the downside. It's not the downside. It's just one side. Where is my one-sided one? Well, I don't have an example of a married put one. It's just, oh, look at that. It almost made it right there. It went right up and touched our break-even point and then come back down. Oh, no, it didn't. That's the dollar calculator. I thought that was that's 800. Let's move these over here. And that's 1,200. So the market just has to be above those red lines to break even. If it's inside that red line, last thing you want it to do is end up inside of here. You don't want it inside of here. And this one is today, right? We don't want it to be inside of here today. Whatever you do, don't land inside of there today. If you land inside of there, we lose money. And we don't lose all of it. We just lose some of it. How come I'm not getting my red box? There it is. Oh, that's a green box. Pretend like that's red. We can change it. Red. Oh, that's too bright. Misty brew salmon. Okay, it's good enough. All right, so you just don't want it to be in there. And you also don't want it to be in here. We're going to slide out. We should see the other one out there. Oh, it's going to be way out there because it's a 15-minute chart. We got 2 days out there. So we don't want it to be out there either. So we'll let's go to daily chart and see there you go. Oh, but we don't have our red lines on the daily chart. Anyway, you got 2 days. You don't want it to be inside these boxes. You don't want to be inside there to the expiration on that one either. You want to be outside that box, either below it or above it, just not inside of it. And if it's inside of it somewhere, you won't lose everything, but you're going to lose something. All right. Because it's got to cover the cost of those options to protect you to the downside. All right. That's our married put. I'm trying to figure out how to. I'm not happy with our iron butterfly. The fact that I lost money yesterday was really frustrating. We worked all that time on the theta. Remember, we was doing all the theta testing, And we nailed it, man. I'm telling you, we nailed the data. It worked perfectly. The problem is it worked perfectly in the sense that on that first day, because we're doing 0 days till expiration, right? That first day, we lost money because the insurance policy wasn't sensitive enough to cover. And we nailed it, man. I'm telling you, it came in at the close of business yesterday, and they were within $97 of each other. That's all it covered. But they were that close. That's not good. We need that one to accelerate enough. We need to make that insurance policy make enough money to cover the losses above our break-even point, right? And so we're going to test that a little bit more. I think we're going to go back to doing a hard hedge. Anything above the break-even point, we need a hard hedge on. And I think we can do that with the magic stick. We only did the magic stick once or twice. I think I want to try the magic stick. Has a problem though. If the market goes up and bounces around over the price of the magic stick, you get in and out, 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 and you get whipsawed to death. And that's where you lose a bunch of money with that hard option strategy. And if you put an option out there, then you have to pay for the premium. And the market has to move far enough to pay for the premium. That's why we have them at the money. But I think the idea is that we're going to have to not put on the opposing side, which means we're going to have to watch the market, which we'd probably want to do if we had the hard hedge anyway. If the market goes up, you could put on the reason I'm showing you a married put is because we could use this, and this is my thought process. And you guys know I'm just brainstorming with you. I don't have all the answers. I'm trying to figure this stuff out. And I'm trying to figure out a way that we can hedge our crazy wild eye iron butterfly. And if we do this, it's going to even get wilder and crazier. I'm trying to figure out how to hedge if we lose money, because we have a hard number. We know the exact number where we lose money, right? And so if we used this type of a strategy right here, we would have to pay for the hedge. But we could pay for the hedge with the premium of the options that we sold. So that's why I'm doing this married put. I want to teach you a married put because I'm thinking we can use the married put as our hard hedge for our iron butterfly. What do you think of that idea? Now we're talking, right? Now you know why I'm showing you this strategy right here. Because if we collect, now remember, we collect in here. This should show you which one of these was the one that shows you what we collect. See, we collect when we sell. In this case, in this example, we collected 300, 600. That's 400, 5, 6, 700. We collected $750. Right? We collected $750. And how much was our hard hedge? $800. See that? See what I'm thinking? See why I'm thinking that maybe we could put on a married put for our hedge to our wild eye crazy eye. We only have to, the problem is you have to pay that. You have to pay that $800 the day that you put it on. And anything, if it falls below it, you don't lose money. You don't lose anything because the premium will expire worthless and you won't pay for it. It'll give you a short position from that point and you will have a long position at that point and it'll just cancel it out. But it's got to pay for the options premium above it to make money. But you're doing that with the premium you're collecting from the butterfly, right? So if you had to put on the hedge, you would have to use all of the premium of the butterfly to pay for the premium of the option. But if the market continued to run, it would be profitable and it would pay for it too, and you'd actually have profit above your break even. What you'd be doing is you would be basically breaking even, setting a break even point because you just used all the premium you collected to pay for the option. And if the market fail, you wouldn't lose anything. But if the market continued to rise, you could actually end up making money. But you couldn't do both sides because you're only collecting 800 and the put option is going to cost you 800. But it wouldn't cost you 800 if you waited halfway through the day, right? I mean, what if you didn't have to put this on until like 12 o'clock? Of course, these dumb guys, they hang on to the premium, right? It would probably be like $700 at noon. So it'd sit there for 3 hours and still be the same price. That is going to be at the money. You could buy them out of the money. What if we did that? You buy them out of the money at the time you put them on, then they're going to be very inexpensive. You could buy a put option way up there for almost nothing. Oh no, wait, because it would be in the money at that point. It'd be very expensive, wouldn't it? So if we were to buy an option way up there, oh, that'd be really expensive. It'd be like, how much would that be? Let's say the same distance. Come in here, and we're going to buy a put way up here. It's going to be really expensive. $2,000. Can't do that. I'll think about it. I'm going to play with the idea, but that's why I'm showing you married puts, because I'm thinking we could use them as the insurance policies on our iron butterflies. Because when we bought the options, we wanted them to be sensitive enough to make enough money to cover our losses. And because we had to buy both sides, it didn't work. I'm trying to beat the system. Guys. Just trying to beat the system. I know guys way smarter than me have worked through this thing a million times, and they've got all the answers. But I don't like to do the same thing as everybody else. I want to do something different because everybody else is just doing the standard butterflies, and there's got to be a better way. There's got to be a way. And I think that hedging, and obviously with a hard hedge, is the best way as long as the market just didn't keep bouncing back and forth across your hedge, your hard hedge. And the magic stick is pretty good at that as long as the market goes straight through it. Now, yesterday it went right straight through it. See that? See that red line? That was our break even. And it went right through it. Boom, one time. Bam, went right straight through it. It didn't sit and dance around over the top of the red line. But if that red line was right here, right through that flat spot, in, out, 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 and then in, out, in, out, in, out, you'd have got your hiney handed to you. That's the problem with the magic stick and doing a hard hedge. It's great if the market just shoots right through your magic stick. But if the magic stick, if it sits there and dances back and forth through a narrow sideways channel and your magic stick is in the middle of that thing, you just get wiped right out. Okay, this thing's up $187, $237. Let's go look at our positions. So the contract itself is up $700. So we got two of them. And our put options are down 237 and 262. So overall, we're up 250. See how that could be a good hedge for your wild eye, crazy eye, iron butterfly? So that's what I want to try tomorrow. I want to try. Of course, we got this thing running through to the end of the day. We can still take it off. We're up $337 right now on our married puts. But are we really? Are we really? Because we don't need two puts. We only need one. So we're actually up more than that. because our long call is actually paying for both the puts. Now remember, this is at expiration. They have to pay these numbers we got drawn in here, 800 and 1200. Right now we got volatility, and the option is only losing 237 of our 800. These are at expiration. So we're up 800, we're up 275, but we're not, because we got 2 insurance policies, we only need 1. Oh no, we don't. We need both, don't we? Because we got 2 longs, because we put on both. So so if we'd have only put on 1, we'd have half of this, $400 here, and we'd be down $200. So we'd be up 200 on that one. 900. Yeah, see? And then we're only down 275, and we'd be up 400. So it'd be up $100. So half of this, 125 on each. We'd be up $125. But because we did 2, and we got 2 different. But look at this. This one here, the cost basis was $1,300, and that's got 2 days till expiration. This one's got 0 days till expiration. We only paid $650 for it, but look, they're both down. This one's down. This one's actually down dollar-wise. It's actually down more. It's got more days till expiration. It's actually down more than the one that's only got 0 days till expiration. That's interesting. You'd think the one with 0 days till expiration would be down more. So that market's rallying. We're up 850. If I'd have kept my straddle from yesterday, man, we'd really be up big. Instead, I lost $100. Should have hung on to it. But I didn't know the market was going to run like this. I just told it to take it off when it hit my what I thought was break even. But because I can't do math, I calculated $100 below break even, because I didn't take into consideration that it already had $100 into the position. All right, guys, I'm going to let this run, and I'll let you know how it goes tomorrow. I'll try and take some pictures of it. I'm going to go over and try and trade some real money today, see how we do. And I still want to play with this idea of using married puts as our insurance policies. Kirk's saying use the chicken wing. Well, this is kind of a chicken wing. It's only one side of the iron condor, iron butterfly. So if we had one sold option down here, that would make that the butterfly, right? That would be the chicken wing. But the chicken wing, it's good, but it doesn't make a lot of money. And you risk, the thing about the chicken wing is it's a lot of tiny winners, and you risk a lot to put it on. But your odds are so highly in your favor, you're like, well, that's why I'm going to do it. The odds are like 80, 90% chance you're going to win, but you're going to win a small winner. And you're going to risk much more than you make. So when you do lose, it oftentimes wipes out half or more of what you've won in the last 4 or 5 or 6 times you did it, right? You win a little tiny, but you lose big. So when you lose, it wipes out a whole bunch of your winners. And that's a good strategy. I mean, I like it. I used to do it a lot. I haven't done it so much anymore. I've been focusing all of my attention on trying to do something that doesn't have big loss potential, has small loss potential. That's why I like these butterflies, because you have big win potential and the loss potential is smaller. It's smaller. The loss potential is you're losing less than you're making. So when you make it, you make $1,000. When you lose $200 or $300. So you just need to be right. But the problem is, if the market runs, we're only right. Our probability is 62% of being right. So we lose, 4 out of every 10 trades. So I'm trying to, when we lose those 4, that's what I'm working, spending all this time and effort and energy with you guys, trying to figure out how we can reduce those 4 losers, 4 out of 10. So we're going to put on 10 of these things. We're going to lose 4 of them. So we're going to make $6,000 and we're going to lose $800, right? We're going to lose 2, 4, 6, 8. but we're going to make $1,000 each time we put one on. You're like, what, Lan? Why are you worried about it? Just do it. Those are good odds. 60% of the time, Ford is you're making money. Yes, but I don't like losing. Because what if you open up your new account? Lan, I want to trade like that. Okay, come and do this little butterfly pattern with us. It's really cool. It works a lot. Works pretty well. And you lose the first 4 times. 4, 4, 4, 4. You lose the first 4 out of 10. And the first 10 you take, the first 4 are losers. Well, now you're not very happy. So I want to figure out a way to try and reduce the losses of the 4. That's all we're trying to do. And we're going to have to do it with hedging somehow. Somehow we're going to have to hedge those losses. And I mean, you could just get out, and that's what other guys do. You go over to that other guy's channel, right? And he just gets out when it hits break even. But how many times has the market left our cone of probability only to come right back into the cone of probability? When you start liquidating your position just because you hit break even, now your 60-40 probability goes out the window. It's done. It's gone. There's no 60-40 on that. So if you just liquidate every time it goes to break even, leaves your cone of probability break even. I don't know. If we drew a horizontal break even, maybe that would be a little bit different. And said we'll let it go because we do it at expiration. Maybe that's what the guy on this channel is doing. He's doing a horizontal break even. That guy's doing a break even on the cone of probability. So he just gets out every time he shows a loss. This guy over here, maybe he'll sit through a loss because he knows that at expiration, as long as it's inside the cone, you can stay in. And that's what we're doing. We have our hard horizontal line expiration, and we're trying to protect above that. So rather than just getting out and saying, well, it broke above our, because it'll come back in. How many times have you seen it come back in? That's why we kind of want a soft hedge. And that's why I'm thinking, hey, this could be that soft hedge. We could do the married put, but I have to experiment with it a little bit. All right, let me experiment with it. Well, I'm going to do it with you guys. You don't have to stick around. It's boring sometimes to do all of these testing things to see what got to see what they do. We got to try them. We got to practice with them. And unfortunately, we've only got one S&P that we can practice on. So we can only do a little bit of practice at a time. We can't. If I had 52 S&P charts, I could do 52 different tests on it at once, but I don't. I only have one. So all I can do is come here with you guys every morning and put on these tests and see if we can't figure out a way to hedge. I think the selling options at the money is a really good strategy. That's why I'm sticking on it so hard. And I know it's like, oh, man, Lan, I'm going to go do something else. I'm going to go watch this guy over here. He just day trades, and that's what I like. I just like to watch the action. I'm trying to find something that can reduce the risk to the point where I can teach it to almost anybody. Go grab the man off the street and say, look, just do this. And we can make this work for you. We can make you make some money every day. We can replace your income with this strategy. And it's pretty safe. There's never anything that's perfect. But I think that we got something here that we're working with these zero DTEs, which are relatively new. We haven't had those very long. I mean, options always have 1 day till expiration, but sometimes we used to have to wait a month to get 1 day to expiration or 0 days till expiration. Then we got to the point where we could do on the S&P, we could have once a week we had a 0 days till expiration. But now they changed it and they put these weeklies out there. This is new. We can have a 0 days till expiration every single day. That gives us the ability to replace an income, right? I mean, if all you have to make is $300-400 a day, 500, our goal is 500, right? $500 a day, that's over $100,000 a year. But, that could be life-changing for many people. And that's what I'm trying to accomplish. I'm trying to figure out some way to just do this every single day. Don't do anything else. Just come and put this on every single day. We're going to change your life. But I got to find out how to hedge it. I got to figure out a hedging way. Bruce appreciates it. All right. I'm glad you appreciate it because it's a lot of brain power, a lot of brain work here, and it's a lot of testing. We got to figure this out. I want to make it happen. And if you guys want to come and work through it with me, then you get to watch the sausage be made. At some point, I'm going to publish this in a book, and I'm going to say, look, this is all the things we did. I'm saving a folder. Look at this folder. This is my folder of all the work we've done. These are all the screenshots of all the stuff we've been doing on these wild-eye, crazy-eyed iron butterflies. I'm documenting everything we're doing. All these things that we've done. Remember all this stuff? All this stuff. Some of you guys have been here for the whole thing. Bruce, you've been here for the whole thing. Kirk, I think you've been here. Michael, you've been here. Gary, I think. Kim Moss, I think some of you guys have been here for the whole thing. On and off. So I'm documenting all this stuff for us and doing it with real money too. You know, as we get to a certain point, I'll throw it into real money and see what it does, because I don't want to just do it in the demo. I want to do it in real money. So we're doing real money tests as well. And trying to build a system, trying to build a strategy that we can work on all together to have the answer. I just want the answer. Just do this. How do you know to do that? Well, because I tested it, and I tested it thoroughly, and it just seems to work. Just do this. There you go. See that? Even $100 can be life-changing. Life-changing. $100 a day could be life-changing. So I'm trying to figure out how to do it the safest way we possibly can in these markets. Again, we're thieves. We're just trying to steal from Wall Street, and Wall Street is doing everything they can to keep us from taking their money. So we have to be very careful and cautious about how we do it, because they want to take their money back. If we get any money from them, their goal is to take it back. They don't want us to keep their money. So we got to figure out ways to keep our money. All right. Keep the money we steal from Wall Street. All right, guys, I have a Sunday school lesson for you. Not that that one wasn't one. That was a pretty good Sunday school lesson. Plan your trade and trade your plan. Don't swing for the fences. This causes horrible losses, turns winners into losers, causes inconsistent results. This is a marathon, not a sprint. Winners have a lot of base hits, have realistic expectations. And that's what I'm trying to accomplish with these butterflies. Just some base hits, all right? Notice that I'm doing everything with quantity one. Just trying to make a couple $100 a day, $300, $400, $500 a day, and do it consistently and without a lot of risk, and not swing for the fences. I know there's guys that are out there swinging for the fences. They put their entire account. We got $42,000 in here. They'll put $42,000 on some super hot stock. GME, going to the moon like a rocket ship. Let's put $42 million on it. There's a guy out there that just did that. Dancing Kitty or whatever he calls himself. Put on there $150 million on a one GameStop stock. And, of course, GameStop flushed, and now he's down a lot. If you put on $182 million and the market flushes, you lose a lot, millions. But he had it to lose, I guess. So, anyway, nonetheless, that's not what I'm trying to do. We're not just here, Roaring Kitty, that's his name. I'm not just here to try and play Roaring Kitty. We're just here to try and change people's lives one trade at a time, right? If we can just make a couple $100 a day, that's life-changing for many people. I'm not Roaring Kitty. All right? I'm not going to come in here and tell you to take your $42,000 entire account and put it on one meme stock. That's not what we do here, all right? We're trying to be very careful, very cautious, very consistent, and build a system that we can work with. Even when we're day trading, where we go a little bit haywire sometimes and kind of push it a little bit, we still need to be very super careful, all right? Cut your losers short, let your winners run. Get in, let the market run. But if it turns and goes against you, just get out. And that's what we need to do with our options too. So we're going to figure out how to hedge this thing. I'm going to experiment a little bit with these married puts, and we're going to see how that works for us. If it works for us, maybe we'll use some of that as our hedge, all right, on our butterflies. All right, guys, that's what I got for you today. We're going to let this run. I'm going to practice with a little bit, and we're going to see you tomorrow, and I'll let you know how it turns out.